My name is Troy Adkins, and I am the founder and owner of Adkins Capital Management, a firm dedicated to providing housing advisory services to households, investors, and communities across the country. As the fourth quarter of 2025 came to a close, the U.S. residential housing market found itself at a crossroads, as explained by an analytical review completed by the investment management firm TCW, titled Resetting the Baseline: Housing Costs and the New American Economic Reality. This presentation also examines the monetary policy actions of the Federal Reserve to accommodate financial conditions that support economic growth amid concerns about inflation and a cooling labor market. This presentation brings those storylines together. It walks viewers through the home price levels of select cities within the Adkins 60 City Home Price Index by highlighting where markets are stabilizing, where they're overheating, and where opportunities still exist. Most importantly, it equips prospective homebuyers with the information they need to make prudent, well-grounded decisions in a market that continues to evolve. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. ACM is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 20 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, more than 8 years of freelance financial and investment writing experience, and more than 5 years of state government experience at the agency and legislative levels. I am also the author of more than 25 published financial and investment articles. Accordingly, I am a 2023 inductee into Marquis Who's Who. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. During the fourth quarter of 2025, research conducted by Adkins Capital Management found that the U.S. residential housing market is experiencing a generational affordability crisis that is structural in nature, not cyclical, with profound consequences for consumer behavior and inflation dynamics. The following is an overview of the TCW report. As of mid-2025, home ownership costs consumed approximately 47.7% of the median household's income, far exceeding the traditional 30% affordability threshold, and persisted even as the Federal Reserve began easing monetary policy. The TCW report traces 5 interconnected transmission channels through which this housing dysfunction is reshaping the broader economy and financial markets. Suppressed consumer spending, reduced labor mobility, shelter-driven inflation stickiness, deteriorating municipal credit quality, and a profound demographic shift that is locking millennials and Gen Z out of homeownership. Interest rate relief alone cannot solve a crisis driven by a structural shortfall of 4.7 million housing units, a frozen resale market caused by the mortgage rate lock-in effect, and a rapidly escalating insurance cost burden intensified by climate risk. The affordability crisis is structural, not cyclical. Owning a median-priced home now consumes 47.7% of median household income, far above the 30% affordability benchmark and at generational highs. The U.S. faces a housing deficit of 4.7 million units, the largest on record, providing a hard floor under home prices and making a rapid correction effectively impossible. Home prices are up about 60% since 2019. The income required to afford a median home has dramatically decoupled from median household earnings. Post-global financial crisis, monetary policy devalued purchasing power and amplified the supply constraint, making the problem worse over the past decade and a half. Affordability is a macro and market transmission mechanism. Shelter costs account for approximately 35% of consumer price index. The massive wave of multifamily completions is pushing national vacancy rates toward 5 to 6% and causing rent growth to decelerate sharply, potentially accelerating disinflation in the CPI shelter component. This creates a cross-current. The for-sale market is frozen and inflationary, while the rental market is softening and disinflationary, giving the Fed more room to ease sooner. The mortgage treasury spread remains stubbornly wide due to elevated rate volatility, meaning Fed rate cuts are not fully transmitting to borrowers. Climate risk and insurance costs are a macro-relevant crisis. Homeowners insurance premiums rose 11.3% year over year as of the fourth quarter of 2025. Residential electricity costs are up roughly 30% since 2021. The crisis has moved from cost to access. In high-risk climate zones, insurers are withdrawing entirely. Insurance non-renewal rates are 80% higher in the highest risk zip codes. Insurance non-renewals in climate-exposed areas directly threaten the credit performance of mortgage-backed securities and the fiscal health of municipalities reliant on property tax revenue. Without insurance, a mortgage cannot be obtained. Insurance non-availability is becoming a direct barrier to housing transactions and credit access. Global property insurance premiums are forecast to grow at a 5.3% rate from 2020 to 2040, with climate change a primary driver. These cost dynamics are increasingly credit relevant for residential mortgage-backed securities, commercial mortgage-backed securities, and municipal bonds, not just homeowners. The mortgage rate lock-in effect has frozen the market. Homeowners with sub 4% mortgages have virtually no incentive to sell and take on a new loan at 6% or more, creating a supply lockout in the existing home market. The lock-in effect was responsible for a 57% reduction in home sales and reduced mobility for mortgaged households by 16% in 2022 through 2023. The knock-on effect suppresses spending tied to moving, furniture, appliances, and home improvement, while constraining labor mobility and dampening broader economic dynamism. Older Americans aging in place, rather than downsizing, compounds the supply shortage. A profound demographic disruption is underway. The median age of a U.S. homebuyer has surged to a record 59 years. The median first-time buyer is now 40, up from 33 just 5 years ago. Millennials and Gen Z are increasingly locked in the rental market. National home sales fell to a 30-year low of 4.06 million units in 2024. Institutional investors captured a record high 30% of single-family home purchases in the first half of 2025. Despite all barriers, homeownership aspiration remains strong, representing vast pent-up demand that will continue pressuring supply constraints. Policy options are constrained and slow. Supply-side solutions such as zoning reform, permitting streamlining, are the only genuine long-term fixes. But political will is inconsistent, and impact is measured in years. Demand-side subsidiaries, such as first-time buyer tax credits, are likely inflationary in a supply-constrained market, putting more money behind the same limited homes. The fate of Fannie Mae and Freddie Mac, currently in conservatorship, remains one of the largest unsolved structural questions. Privatization could raise and volatilize mortgage costs while reducing affordable housing support. FHFA set a low-income home purchase goal of 25% of all GSE single-family loan purchases for 2025 through 2027. Any adjustment represents a non-monetary lever on mortgage availability. With this overview of the ACM research in mind, let me now turn your attention to our analysis of the Federal Reserve's monetary policy. The general theme of this section is that the Federal Reserve cut interest rates twice during the fourth quarter, citing rising downside risk to employment and a weakening labor market. In the fourth quarter, the Federal Reserve continued its rate-cutting cycle, citing increasing downside risks to employment. Monthly job growth had been below average from May through September of 2025, and the unemployment rate had risen approximately half a percentage point since the start of the year. Inflation, while still above the 2% target, showed diminished upside risk. A government shutdown further clouded the outlook by delaying October and November economic data. The Federal Open Market Committee cut the federal funds rate by 25 basis points at both its October 28th and 29th and December 9th and 10th meetings, reducing the target range from 4% and 4.25% to 3.5% and 3.75%. The third and fourth consecutive quarter point reductions and the lowest level since November of 2022. The December decision was not unanimous. Two regional presidents dissented in favor of holding steady, while one governor pushed for a larger half-point cut. In response to a host of economic factors, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at approximately 6.43% and ended the quarter at approximately 6.15%, a 2025 low and the lowest level in over a year, per Freddie Mac data. The national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 2.67% on December 17, 2020, and the all-time high of 18.63% in October of 1981. The unemployment trend was the central fact that emerged in the fourth quarter of 2025 and directly drove every Fed decision. The unemployment rate climbed from 4% in January of 2025 to 4.5% by November of 2025. And the November jobs report, delayed by the government shutdown and not released until mid-December, showed the rate had hit 4.6%, its highest level since September of 2021. The chart highlights this story in 3 layers. In looking at the chart annotations, the light blue bars show the relatively stable 2024 baseline, with rates between 3.7 and 4.3%. This is where labor market softening began. The dark blue bars show the gradual Q1 through Q3 2025 deterioration. The red bars spotlight the fourth quarter of 2025 with a clear 4-year high annotation on November's 4.6%, the highest since September of 2021, reading, and a gap for October where BLS data was unavailable due to the shutdown. With this overview of the Federal Reserve's monetary policy actions in mind, let me now From a finance-based perspective, our proprietary valuation methodology analyzes the relationship between home price levels, household income levels, the percentage of pre-tax household income allocated to housing, and the cost of debt for a 30-year fixed-rate mortgage loan. From the first analytical perspective, our valuation methodology calculates the justified mortgage loan interest rate, which represents the cost of debt that justifies the home price level with the household income level, taking into account that 28% of household income will be allocated to servicing the mortgage loan. From the second analytical perspective, our valuation methodology calculates the justified percentage of household income amount, which represents the percentage of pre-tax household income that justifies the home price level with the household income level, taking into account the prevailing national average mortgage loan interest rate. Based on Adkins Capital Management's proprietary housing analytical methodology, this section of our presentation pertains to ACM's comprehensive housing analyses. The general theme of this section is that an overwhelming majority of cities, 56 out of 60, featured in the Adkins Home Price Index, are flagged for housing prices that exceed sustainable levels. When we examine the Adkins 60 City Home Price Index for the fourth quarter of 2025, one conclusion became unmistakable. 56 cities in the index were classified as overpriced when measured against the percentage of household income needed to justify current home values. And at the very top of that list
sit the 5 most overpriced markets: New York City, San Francisco, Los Angeles, Newark, and Miami. These are the metros where the gap between what homes cost and what local incomes can support has stretched the furthest. To understand just how wide that gap has become, we ran a relative price level analysis. Even if you reduce the 30-year fixed mortgage rate from 6.15% all the way down to zero, the home prices in these 5 cities still wouldn't be justifiable based on local incomes. The disconnect is that large. And the picture doesn't improve when we flip the analysis around. To classify these markets as underpriced, buyers would have to devote between 72% and 81% of their household income to housing. Those levels aren't just unrealistic, they're fundamentally unsustainable. The takeaway is clear. In the nation's most expensive markets, the affordability challenge isn't a temporary condition driven by rates or short-term volatility. It's structural. Prices have moved so far beyond what local incomes can support that traditional affordability metrics simply break down. When we look at what it would take to truly justify today's home prices in the nation's most expensive markets, the numbers tell a striking story. For each city in the index, the median household income would need to rise dramatically into a range between roughly $132,638 and $377,286 just to support the median home price at traditional affordability levels. That's the scale of the gap we're dealing with. And when we reverse the analysis, the picture becomes even clearer. Using each city's actual median household income, the quarter-ending national average mortgage rate, and the long-standing guideline that no more than 28% of pre-tax income should go toward principal and interest, the justified home price levels for the 5 most overpriced cities fell between the range of $185,432 and $541,560. In other words, the prices buyers should be paying based on income are far below what the market is currently demanding. For households trying to navigate this environment, understanding the degree of overpricing isn't optional, it's essential. That's why prospective home buyers should turn to the Adkins Residential Home Valuation Analyzer. It provides a clear, data-driven assessment of how far local prices have drifted from what incomes can realistically support, helping buyers make informed decisions in a market where traditional signals no longer tell the full story. On the opposite end of the spectrum, our analysis identified only a handful of markets that remain genuinely underpriced. Out of all 60 cities in the Adkins 60 City Home Price Index, just 5 were classified as underpriced in the fourth quarter of 2025. Those cities, Detroit, Fargo, Jackson, Wichita, and Huntington, stand out as rare pockets where local incomes still align with or even exceed what current home prices would traditionally require. But understanding why these markets are underpriced requires looking at the mechanics behind the numbers. To classify homes in these 5 cities as overpriced, one of 2 things would have to happen. First, the national average mortgage rate, currently at 6.15%, would need to rise dramatically, surpassing each city's justified mortgage rate, which ranges from 7.67% to 11.84%. In other words, rates would have to climb far beyond today's levels before these markets would lose their affordability advantage. The second possibility is behavioral rather than mathematical. Prospective homebuyers would have to decide that it's simply imprudent to spend the justified share of their income on housing in these cities. And given how far below national norms those percentages currently sit, that shift in sentiment is unlikely. Taken together, these dynamics paint a clear picture. While most major U.S. markets are struggling with structural affordability challenges, a small group of cities still offers meaningful value. Places where incomes, prices, and mortgage rates remain in balance, and where buyers can enter the market without stretching beyond their means.
Now that our quarterly residential housing market review is complete, here is some valuable information that you should consider. First, you can conduct similar housing analyses for your community and for your specific home purchase opportunities by subscribing to use the Adkins Residential Home Valuation Analyzer on Amazon.com. Simply search for residential real estate software to watch our 15-minute movie presentation and to subscribe to use our software. Second, there is a wealth of additional housing information on the Adkins Capital Management website, including our comprehensive home price index, interactive map of city housing analyses, newsfeed of pertinent housing information, housing methodology patent application, reverse mortgage loan analysis, movie catalog of quarterly residential housing market reviews, housing valuation methodology presentations, and tactical and strategic residential real estate hedge fund model portfolio. By visiting ACM, you can gain valuable insights into the housing market and make well-informed home purchase decisions. This is Troy Adkins saying thank you for taking the time to listen to this presentation.